Hello there. Welcome to my class. My name is Marcio de Paula, and I will be your instructor for today's lesson. Today we will be talking about QuickBooks Desktop 2020 Chapter 14. Reporting, adjusting entries, and closing the books. It's now time to wrap up all you've learned and finish out the accounting cycle. In this chapter, you will work through the last 4 steps of the cycle as you close out the fiscal period. You will dive in and look a bit more closely at what's behind the scenes by making general journal entries as well as inventory adjusting entries. You will also produce the major end-of-period financial reports trial balance, worksheet, income statement, statement of owner's equity, and balance sheet. Finally, you will learn how QuickBooks closes the books for you and how to set a closing date. By the end of this chapter, you will be able to prepare a trial balance report, make general journal entries, adjust inventory, create financial statements, close the books in QuickBooks. Now, let's get started. We've fast-forwarded in time to December 2022, and Jimmy has asked you to close Parrots Paradise Resorts books for the year. You will begin by creating a trial balance report, which will tell you whether the debits and credits are equal and display the balances of each account. Then it'll be time to look at what a pen and paper worksheet includes, and how the information flows from column to column through it. Next, you will look behind the scenes at the Make General Journal Entries window, where you will enter adjusting entries for depreciation and the opening balance equity account. Any necessary inventory adjustments will also be made before creating the end-of-year financial reports. Closing the books in QuickBooks. The last 4 steps of the accounting cycle deal with closing the books at the end of a fiscal period. At the end of the fiscal year, QuickBooks uses the fiscal year information based on what you entered when you first created your company. You can view this information through the My Company window, accessed from the Company menu. You can set a closing date in QuickBooks, although QuickBooks will perform year-end adjustments automatically based on your fiscal year. You will learn how to set a closing date in QuickBooks at the end of this chapter, after you've explored the rest of the accounting cycle. The final steps of the accounting cycle. The final steps result in your company books being closed for the past fiscal period and prepared for the next one. For many companies, the last steps of the accounting cycle are carried out by an accountant. A company needs to decide whether it will use an accountant to close the books or if it's something it will take on independently. So far in your path through the accounting cycle, you have ensured that source documents are available and organized before analyzing and recording transactions. QuickBooks posted them in a journal and to ledger accounts behind the scenes. Now you will prepare reports to show how your company performed for the fiscal period and close out temporary accounts. As you explore these final steps, you will see how QuickBooks addresses each. Permanent accounts. Accounts for which the ending balance for one fiscal period is the opening balance for the next are called permanent accounts, also called the balance sheet accounts. Similar to your personal checking account, you wouldn't zero out your account at the end of each year, it continues on from one accounting period to the next. Temporary accounts. Not all accounts are permanent. Called temporary or nominal, the income and expense accounts are zeroed out at the end of each fiscal period, with the amounts moving into an equity account as either a net income, if income was greater than expenses, or a net loss, if expenses exceeded income for the period. An example of a temporary account is a sales account. The income summary account. If you were doing paper-based accounting, you would use an income summary account to clear out the temporary account balances and move the lump sum to an equity account. QuickBooks doesn't create an income summary account, but it takes the net income or loss resulting from the balances in your income and expense accounts and moves it to the capital/equity account for you. You will learn more about this temporary account as we progress through this chapter. QuickBooks Automatic Year-End Adjustments. Specific tasks are performed automatically behind the scenes at the end of your fiscal year, such as closing out temporary accounts by moving the balances to a virtual income summary account, determining a net income or loss for the company to be displayed on the balance sheet for the last day of the fiscal year, after transferring the balances from the temporary accounts. automatically transferring the net income or loss from the last day of the fiscal period to the retained earnings account on the first day of the new fiscal period. The result of this behind-the-scenes action is that you will start off the new fiscal year with a net income of 0 and a 0 balance in each of the temporary accounts. Year-end reporting. When you're doing pen and paper accounting, you must prepare a trial balance report. This involves displaying all the ledger accounts and their balances on one report to ensure debits equal credits. When you use QuickBooks, though, you can't record a transaction if the debits and credits are not equal, so a more useful purpose for the trial balance report is to prepare for adjusting entries. As you've seen, QuickBooks provides users many reports to help them tell the story of their business. In addition, there are reports contributed by other users that you may find of value. These reports are organized into 12 categories, with additional categories for industry-specific versions. Custom reports. If you can't find the perfect report for your business, you can create custom summary and detail reports. The Help Me Choose window guides you through deciding which custom report to create. Cycle Step 4: Unadjusted Trial Balance. In the third step of the accounting cycle, QuickBooks posted the amounts from the journal that documents all transactions to individual account ledgers behind the scenes. Step 4 of the accounting cycle involves creating the trial balance report. This initial trial balance is termed an unadjusted trial balance, as it shows the balance prior to performing any necessary adjusting entries. In traditional accounting, the trial balance report adds up all the debits and credits so mistakes can be traced if debits and credits don't equate. Because QuickBooks always adds correctly, you don't have to do a trial balance. Nevertheless, QuickBooks provides the trial balance report for users who want to see the data in this format. The trial balance report lets you look at the ending balance of every account in the chart of accounts for a chosen period of time. It can help guide you as you create adjusting entries. You can use the Quick feature to find the source of the amounts on the report. The trial balance report compiles all accounts in your ledger that have a balance into one report to verify that debits equal credits. The report at left is before adjustments, the one at right is after. Note the addition of the depreciation expense, accumulated depreciation, and inventory adjustment accounts. Preparing a worksheet. In pen and paper accounting, a worksheet is a report you create to assist yourself when preparing year-end financial statements. The worksheet has 5 sets of debit and credit columns that represent these sections, displayed from left to right. Trial balance. Adjustments. Adjusted trial balance. Income statement. Balance sheet. The information from the trial balance report is, unsurprisingly, displayed in the trial balance section. You work across the worksheet as adjustments are made and then recorded in the adjusted trial balance section. Finally, the amounts from the adjusted trial balance are transferred to the income statement and balance sheet sections, based on which accounts are found on each. Because QuickBooks does this behind the scenes, there is no worksheet for you to physically produce. Digging in behind the scenes with adjusting entries. QuickBooks has been performing journal entries all along as you enter transactions, whether you're depositing funds or paying bills. Still, there may be times when you have to make your own adjusting journal entries, especially before closing the books for a period. When you venture into the General Journal Entry window, you will see a debit column and a credit column. As you create your journal entries, you must make sure that the debits equal the credits. Don't worry. QuickBooks won't let you record a transaction until this equation is in line. Depending on your version of QuickBooks, the Make General Journal Entries window may look a bit different. The images in this text show the Premier Accountant version. Journal entries. If you're familiar with manual accounting, you'll notice that the journal report shows the entries as they would appear in the pen and paper journal used in the manual accounting. You run the journal report to see all transactions made within a certain period. It can also be useful in locating problems. The journal report shows all transactions made in QuickBooks, including adjusting entries made through the Make General Journal Entries window. This illustration displays adjusting entries from December 2022. General journal entries are not to be taken lightly. They're used to balance the books and for the reasons listed in Cycle Step 5, below, only when there is no other way to fix the issue. When making a general journal entry, at least 2 lines are used. Debit entries are listed first, followed by credit entries. Cycle Step 5, Adjusting Entries and Adjusted Trial Balance. Adjusting entries are made at the end of an accounting period to bring some of the general journal account balances up to date so they're correct on the financial statements. Examples of adjusting entries that are often made include updating the book value of fixed assets by recording depreciation for the fiscal period, updating prepaid accounts, other current assets, by transferring the amount used in the fiscal period to an expense account, transferring balances out of the opening balance equity account to their correct resting place. After the adjusting entries have been made, an adjusted trial balance is prepared. Cycle Step 5, Adjusting Entries and Adjusted Trial Balance. Adjusting entries are made at the end of an accounting period to bring some of the general journal account balances up to date so they're correct on the financial statements. Examples of adjusting entries that are often made include updating the book value of fixed assets by recording depreciation for the fiscal period, updating prepaid accounts, other current assets, by transferring the amount used in the fiscal period to an expense account, transferring balances out of the opening balance equity account to their correct resting place. After the adjusting entries have been made, an adjusted trial balance is prepared. Preparing financial statements. After adjusting entries have been made, it's time to produce the company's financial statements. Financial statements are very important in that they are used both internally and externally to learn about the financial health of a company. Internally, reports are used by management to make decisions regarding operations. It's beneficial to not only look at the current year's statements, but also to compare them to the statements from the previous fiscal year. Externally, the financial statements are used in a variety of capacities, such as to determine whether money should be lent to a company, whether a business is profitable, and whether to purchase stock in a company. Remember that a company's statements should be based on objectivity. Cycle Step 6, Financial Statements. The 6th step in the accounting cycle requires that financial statements be produced. 3 statements must be produced: income statement, also known as the profit and loss report, statement of owner's equity, and balance sheet. Some users of your company's financial data may also need a statement of cash flows. The income statement. The income statement, aka the profit and loss report, displays the income and expenses generated over a specific period of time. In this case, the net income or net loss tells a story about the financial health of the company. When using pen and paper accounting, the values to be displayed on the income statement will come from the income statement section of the worksheet. The income statement will have either 2 or 3 sections. It always has income and expense, and if the company deals with inventory, then a cost of goods sold section is also displayed. Remember that you are to match the expenses to revenues within the same fiscal period. The income statement helps you to make sure this happens. The income statement is made up of temporary accounts. Therefore, it begins each fiscal year with all accounts displaying a zero balance, because the previous period's amounts will have been transferred to the retained earnings account as either a net income or a net loss. Analyzing the income statement. There are different ways to analyze a company's health using the income statement, depending on the purpose of the analysis. The statement of cash flows is a more reliable report in many instances, but the income statement can still be a useful tool for analyzing aspects of the business such as ratios to measure profitability, gross margin percent, net income percent, growth trend analysis, earnings versus expenses, comparison to similar businesses, return on investment. The balance sheet. The balance sheet displays the permanent accounts, which make up the elements of the accounting equation: assets equals liabilities plus equity. It reflects the financial condition of a business on a particular date. In pen and paper accounting, the values for the balance sheet come from the balance sheet section of the worksheet. Remember that the activities of the business can be divided into time periods. Just as the income statement is not a perfect tool for analyzing a business, the balance sheet is not always the right tool. It can, though, be useful for looking at ratios to measure profitability, liquidity, and financial strength in the long run, current ratio, quick ratio, return on assets, and return on equity. Comparison of assets to liabilities over time. Working capital, current assets less current liabilities. Leverage, debt, and worth. The statement of owner's equity. The statement of owner's equity shows the capital at the beginning of the fiscal period, any additional investments as well as draws by the owner, the net income or loss, and the ending amount. Amounts on the statement of owner's equity come from two sections of the pen and paper worksheet. The net income or loss comes from the income statement section, while the beginning capital, investments, and draws come from the balance sheet section. QuickBooks does not provide this as a report for you. One way to look at the change in owner's equity from one fiscal period to another is to customize a balance sheet previous year comparison report by filtering it to show only equity accounts. Reports that compare data from previous fiscal periods. QuickBooks provides ready-made reports to help you compare company financial information from the current and previous fiscal periods. The profit and loss previous year comparison and balance sheet previous year comparison reports showing the dollar values for each year and detail the change in amount and percentage. In addition to the preset reports, you can customize summary reports to show the same previous period information. Financial statement headers. Report headers are laid out in a specific way in accounting reports. The first line is the company's legal name, the second line is the report name, and the third line is the report time period. Headers for reports that provide a snapshot in time, like the balance sheet, show a specific date, such as December 31, 2022. Reports for a period of time, like the income statement, show a header date that references a range, such as for the year ended December 31, 2022. QuickBooks provides default report headers for you, but these can be edited. The balance sheet report displays the date the snapshot was taken, whereas the income statement shows the date range from which the data is drawn. Wrapping up the accounting cycle and closing the books. To wrap up the accounting cycle, you need to zero out the temporary accounts and move the resulting net income or net loss to a permanent account, specifically an equity account, to begin the next fiscal year. You also need to zero out the account that tracks the owner's draw or shareholder distributions. Cycle Step 7, Closing Entries and the Post-Closing Trial Balance. In pen and paper accounting, there are 5 tasks involved in the final step of the accounting cycle. 1. Transfer the ending amounts from all income accounts to the income summary account. 2. Transfer the ending amounts from all expense accounts to the income summary account. 3. Transfer the amount in the income summary account to the capital account. 4. Transfer the amount in the owner's draw account to the capital account, retained earnings. 5. Create a post-closing trial balance report. Each task results in journal transactions that close out the temporary accounts and move the amounts to income summary. Then a transaction is recorded that transfers the amount from income summary to the capital account. Take note. If the income summary account balance is a credit, you debit that account and credit the capital account. This signifies that the company has experienced a net income. If the income summary account balance is a debit, you credit that account and debit the capital account. This signifies that the company has experienced a net loss. When you close the books in QuickBooks, all of this is done for you behind the scenes. This step will result in either an increase or decrease in the capital account balance, based on whether the company saw a net income or a net loss, and the amount of funds the owners drew from the company. The final report that you will create is a post-closing trial balance that shows all temporary accounts with a zero balance. It also lets you check one last time that debits and credits are equal. Only permanent accounts display in the post-closing trial balance. If you choose not to close the books, these year-end adjustments will be made automatically. Income and expense accounts are zeroed out. Net income is adjusted so the equity section of the balance sheet displays a line for net income the same as it was on the last day of the prior year. Retained earnings are increased by the prior year's net income, and then decreased by the same amount, so you start with a net income of 0 for the new period. Setting a closing date. As you know, you're not required to close the books in QuickBooks. When you close the books by setting a closing date, QuickBooks automatically transfers the net income or net loss to retained earnings and restricts access to transactions prior to the closing date by requiring a password. After closing the books, you can run the condensed data utility, which cleans up your data. Only the company file administrator can set a closing date and allow or restrict access to prior period transactions by the user. Working with a company file after closing. After you've set a closing date, there's one additional step to the accounting cycle. It has to do with creating another trial balance report. You also may choose to clean up your company's data after you close the books by condensing the company file. Correcting transactions from a closed period. After setting a password for a closed period, you'll need to enter it in order to change or add a transaction in the prior period. You can produce the closing date exception report that shows any transactions dated on or before the closing date that was entered after you set the closing date. The audit trail. The audit trail feature of QuickBooks allows you to track every entry, modification, or deletion to transactions in your file. The audit trail feature is always on to make sure an accurate record of your QuickBooks data is kept. The audit trail does not track changes to lists, only to transactions. This can help you research transaction history and determine whether certain types of fraudulent activity are occurring. To view the audit trail, run the Audit Trail account, which is available from the Accountant and Taxes category of the Report Center. Condensing the company file. After you've closed the books, you may decide to condense your company file. Condensing the file is a way of reducing a large company file that has accumulated a lot of data over the years. This process also gives you choices to replace transactions from before the company closing date that are no longer needed with summary transactions. Transactions that will not be summarized include those with open balances or that are linked to others with open balances, any that have not been reconciled or cleared, any that are marked to be printed. QuickBooks will not remove any payroll transactions for the current calendar year because of payroll tax reporting requirements. Condensing your company data has huge implications, so make sure you understand what you're doing before you perform this operation. After you've decided what to clean up during the condensing process, QuickBooks will create a copy of the company file, which will be in its original state prior to the condensing process. The name of the file will include the date and the word copy appended to the end. The location of the copy will also be displayed. QuickBooks will also verify the integrity of your company file. Remember that transactions dated after your company closing date will not be affected by the cleanup process. During the process, you will be asked the date to use to remove transactions, how you want inventory to be handled, summarized or with details, which transactions to remove, such as uncleared bank and credit card transactions, and time and mileage activities to name a few, which list entries to remove, if any, such as accounts, classes, and completed to-do notes. An advantage to condensing the company file is that it removes list entries that haven't been used since the prior period. When all the transactions for a list entry have been deleted or summarized, you can then delete the list entry. You can reduce your company size without removing any data through data file optimization. Essentially, QuickBooks removes the information in the audit trail from a previous period, which decreases the company file size and may help your company run more smoothly as a result. Don't worry though, QuickBooks will prompt you to save a copy of your file with the audit trail intact before this process, so you can go back and view it later, if needed. Make sure you have completed all year-end activities, such as producing W-2, W-3, and 1099 NISC forms, before cleaning up your company file. Working with an accountant's copy. If your accountant needs to adjust your QuickBooks file, but you don't want to lose access to it while it's in use, you can create an accountant's copy. Your accountant can make the needed adjustments, and you can at least keep up with your daily transactions. There are some tasks you cannot do while your accountant is working on your file, such as edit or delete accounts, add, edit, or delete transactions dated on or before the dividing date, reconcile an account, Just as with setting a closing date, only the company file administrator can create an accountant's copy. When the accountant's copy is created, QuickBooks appends the date and time the file was created to the file name. Example, QuickBooks 2020 ACCT Transfer Deck 04, 2020 0820 p.m. The extension will be QBX. When you create an accountant's copy, you must set a dividing date. The dividing date determines the fiscal period that the accountant will be working on. The accountant will be able to work on transactions prior to that date, and you will be able to continue to work entering transactions after that date. Be careful when setting this date to ensure that your accountant will have the access needed, and that you will still be able to modify recent transactions, if necessary. If your accountant is making adjusting entries, it makes sense to set the dividing date as the last day of the previous fiscal year. It's generally best to set the dividing date about 2 weeks after the last day of the fiscal period you need. Typically, it will be the end of a quarter. This way the accountant can move transactions between the two periods, if needed. The dividing date determines the date from which your accountant can make changes to your company file. It also dictates your own access to your company file while the accountant is working. You will encounter 4 tasks when working with accountant's copies: saving, sending, importing, and removing restrictions. All of these are accessible through the File option on the menu. Saving an accountant's copy of the file, you have 2 options. The first is to create an accountant's copy. You and the accountant can work independently, and you later import the accountant's changes. The second is to create a portable or backup file if the accountant needs to set up the books, do daily bookkeeping, or work on payroll. You won't be able to work on the file until the accountant is finished. Sending the file, you can email the file or save it to a CD or other storage media to provide to your accountant. Or, use the accountant's copy file transfer service. It requires internet access, as the file will be uploaded to Intuit's web server. Your accountant will receive an email with a link to download the file. If you use the accountant's copy file transfer service, the company file will not be available during the process of creating and uploading the file. The file will show "Accountant's Changes Pending" on the title bar. You must wait for the process to be finished. Importing the file. When you receive the file back from your accountant, you must import any changes into your company file. When you do this, you'll be prompted to create a backup copy of your file. This is important in case the import is not successful. You will still have a workable copy of your company file. During the import process, it's up to you to accept all or none of the changes into your company file, and to view any notes left by your accountant. Removing restrictions on your file. To cancel an accountant's copy, you must choose to remove restrictions. If you do this though, you won't be able to import the accountant's copy changes. On the other hand, if you accidentally create an accountant's copy file, just cancel it to work with your file in normal mode. That's all for today. Your next step is to review this chapter and get the exercises started. Thank you for participating in today's lesson. I will see you in our next session. And remember, if you don't know, askmarcio.com.